given the events in the Middle East, could be more of an issue. But barring something that we can't forecast, I do think the most likely scenario is that things inflation moderates in a reasonably graceful way here, and that would be consistent with the Fed cutting rates this year. It's just a question of how many times and when they start to do that. Their own forecast is for 3/4 point rate cuts this year. That feels about right to me. Markets are more optimistic. 6 rate cuts this year. That seems a little bit overdone, but I wouldn't argue with anyone if they're saying we get a fair number of rate cuts this year because of the moderating inflation.
Okay, sure. Allison, you had a great column out at the beginning of the year, sort of talking about some of the risks. Where do those risks lie, as you see it?
Well, certainly, I mean, said with energy prices, certainly now with what's happening in the Red Sea, I'm not very good at making forecasts, so I tend to more look at where sources of vulnerabilities that, because there's always something that comes up every year. So also, as I wrote in that column, to some degree, the Fed got lucky in that they were able to bring down inflation so costlessly. And that was just because a lot of sort of maybe pandemic overhang um, factors, and a lot of those have run out now. I mean, labor markets are quite a bit tighter. I just was reading a note from the Minneapolis Fed saying that vacancy rates are actually much lower than they look. So that means that, if credit conditions continue to tighten, then that means that there might actually start to be trade-offs, say higher unemployment, things like that, which will make the Fed's job harder if there are any shocks and they do have to keep rates high, or even if something big happens, potentially even increase rates again. So
Yeah. I'm sorry, Alex. Let me just cut you off for a moment here because we have the number, and so it comes in headline month on month comes in at 0.3%, which is just a tad bit above what the market was expecting at 0.2% in the consensus. Core month on month, sort of bang on 0.3% versus an expectation of 0.3%. All of this sort of works out to headline year on year comes in a little bit higher than what the consensus was expecting at 3.4. I'm sorry, comes in at 3.4. The expectation had been 3.2. So does this move the needle for anybody? These few decimal points here, Mark. What do you think?
I don't know, Jonathan. I have to look at the details, but it feels like we're splitting hairs. We're now down to the second, third significant. I don't know whether it was rounded up, rounded down. Feels like it might have been come in a little hotter than anticipated. But if it's due to energy prices, where in electricity or some other outlier, then no big deal. But it does feel a little bit on the high side of my expectation. But in the grand scheme of things, probably pretty close to. Let's put it this way: I don't think it's a big enough difference to make me change my forecast or make me feel any less confident about my forecast.
Yeah, sure. And I did put up the yield on the 2-year Treasury note here on the screen. Yeah, sometimes these things are a bit of a knee jerk reaction. Computers doing what computers are going to do. So I like to wait a couple minutes and see how these things shake out. But the initial knee jerk reaction is for yields to jump about 5 basis points on the intraday chart on the 2-year Treasury note. So, Allison, I cut you off sort of mid-sentence there. Let me turn back to you so you can finish your thought and also weigh in on what we're saying here.
Yeah, I pretty much had finished my thought. Just that, the easy part might be over. But yeah, I think this is a good report. I mean, I think we are splitting hairs. This is pretty close, certainly within the bounds of what we expect. I just had flashbacks to when we did this, I think in 2022, and would just be like shocked at how big it was compared to what we expected, like many basis points. So yeah, I think it's a good report. I mean, so far, no surprises. I mean, we haven't looked deeper into the data, but it looks promising.
Sure. So let me. I do want to come back to the details of the data in a couple of minutes, but in the meantime, I did want to talk about implications for monetary policy. Uh, and so the question here is, we often hear Fed speakers. New York Fed President John Williams was on the tape yesterday. We often hear Fed speakers say, we still want to keep a restrictive stance for a while, right? We think that that's the prudent thing to do going forward. And so my question to my two economists on the panel here is, now that we have, again, CPI inflation running year on year at 3.4% instead of the much higher figures that we had in 2022, what is a restrictive stance? How low can they go and still be restrictive, as it were? And if it's not a number, I guess how would you explain what they're talking about when they call out this phrase sufficiently restrictive?
Well, I
Mark,
guess,
what, or
sorry.
Allison, please.
Well, I guess restrictive would be above our star. I mean, whatever that is, which I think the Fed is saying is what, like, 50 basis points, something like that. And so, but that's real. So, if inflation's 3% and the Fed funds rate is, 5 plus. So right now it's about 200 basis points above our star. So it'd still be restrictive. So they could probably, you know, I mean, if assuming that they feel like their work is done, cut, I guess 200 basis points depending on where inflation is.
For sure. Do you share that view, Mark, in the sense that I think a lot of people, when they do the first cut, they might take they'll take a lot of signal from that, saying the inflation fight is over, but perhaps, with inflation coming down as much as it is, there's room to be cutting and still be restrictive as the Fed defines it. Am I right about that?
Well, I think the framework I have is the same as Allison's. I think I'd look at this relative to the equilibrium rate, the R star, which is theoretical. We don't know what that is exactly, but it feels like, and the Fed puts it nominal at 2.5%. So we're at 5.5% funds rate, 2.5% R star. That's 3 percentage points. That's a fair amount of restriction on the economy. And I think that's appropriate as long as inflation is above target. I think as the forecast of inflation coming back to target becomes more of a reality and everyone feels confident that that's going to happen, then I think it is appropriate to bring the funds rate back down closer to R star over time. And that's kind of the script they're following. I would make one point though. It feels like to me R star might be higher than it has been in the recent past. It may not be 2.5. It may be 3.5, for lots of different reasons. I mean, one reason may be that the economy is just more rate insensitive than it has been historically, and you can see that in a number of ways. Most significantly, households and businesses have done a very good job of locking in the previously record low interest rates. And so they're very insulated from the run up in rates now. So debt service burdens, a percent of after tax income that households are devoting to servicing their debt, has not moved. It's very low and it has not increased. Same with the amount of interest expense businesses are paying relative to their cash flow is very, very low, has not begun to increase. So that would suggest that these higher rates are just not biting in the same way as they have in times past, and that would argue for a higher R star. So, but if it's not 2.5, it's say 3.5. The monetary policy is still quite restrictive, and it is now prudent as inflation comes in, and we all get more confident about inflation coming to target, that the Fed lowers rates back closer to that R star over time.
Fair enough. I put up a decomposition on our screen of the numbers that we just got, and I wanted to look through them with you all and sort of understand what this number is telling us. So what I've put up here is a decomposition of month on month, seasonally adjusted core inflation. And just if the labels are too small for everybody to see. The red bar is our core services. The um, the blue bar is our core goods. So core goods, just sort of looking at it, not contributing much of anything upward or downward. It's still very much a core services story, and I figured we could dig in there a little bit and see what's behind that. So I'm now zeroing in on core services itself to try and figure out what's going on here. So again, this is the month-on-month seasonally adjusted. The contribution from shelter looks like it actually ticked up a
Yeah.
tiny bit, and that is sort of a light purple in our,
Yeah.
in our screen. I wouldn't know how to a purple pastel, if you will. Um, I I don't know. Let's see. Okay, so shelter ticks up. Medical care services contribution ticks up a tiny bit. Um, transportation services sort of were big, a surprisingly big contribution, I would say, last month. Not very much of an issue this month, but we do see recreation services tick up as well. I'm looking at this in my table, and it's the sort of green bar in the graphic up here. So first glance, we get a little bit of a little bit of a surprise. Perhaps part of it could be coming from that slight uptick in shelter and that slight uptick maybe in recreation services. Do those details mean anything to you, Mark?
Well, yeah, looking, while you've been reading the chart, I've been looking at the data a little bit more carefully. I'm looking at the kind of the components, the things that surprised to the upside relative to my expectation. First and foremost is the cost of housing, shelter. That was
Mm-hmm.
stronger than I would expect. Um, it's been very persistently strong, but again, I don't expect that to continue given how rents have behaved over the past year. They're flat to down, and that should translate through. So I'm not so worried about that. Um, Also, electricity. I mentioned electricity, I think, in our early part of the conversation. That reflects mostly natural gas, and natural gas has pushed up a little bit over the last month or two, and that's being I think reflected in electricity costs. I don't think that's persistent, though. I don't think natural gas is going anywhere fast. And then the other is thing that's a little bit surprising is new vehicle prices. It looks like they were up, and I expected them to be down, and they will decline. We're now on the other side of the pandemic, and we're seeing improved production, not only here in the U.S. but in other parts of the world like Japan and Germany. So inventories are now starting to rise, and that should put downward pressure on new vehicle prices. So I expect that to kick in at some point, but it didn't happen. It didn't happen in December. Instead of a decline, we got an increase, and that was a bit of a surprise. So to me, those were the three things that were kind of a bit out of bounds, and why we're on the high side of expectation. But when I say on the high side of expectation, again, we're debating second significant digit here, right? So it's like, on the margin.
Yeah. What do you think? I guess, first of all, would one of you mind explaining the unique dynamics about what's going on with shelter? Because I think this is important. Economists have very good reasons to expect that shelter will continue to moderate because of how this works in the index, right? Any takers?
Sure. So this is a very large component of CPI, the cost of shelter, both if you're renting a home or whether you own your home and you're paying what the Bureau of Labor Statistics calls owner equivalent rent, kind of implicit rent on the home that you live in. And it's over a third of the index. So it's of the CPI, the Consumer Price Index, what we're focused on here. So it's a really important component. Ultimately, the Bureau of Labor Statistics ties their estimate of the cost of owning a home or renting a home to rents out there in the marketplace. They'll see what people are paying for actual rent and use that as a basis for estimating what they think the growth in the cost of housing services are in the CPI. There's a long lag between the shifts in market rent and what it means for the CPI, just because of the fact that leases roll over once a year, and only a certain number of folks will roll over in a given month. So it takes time for that to kind of play through. But if you look at market rents, and there's lots of different measures of market rents, but if you go look at apartment.com or Zillow or Moody's, whomever you want to look at, they've been I keep saying flat to down, and that's what they've been, flat to down since this time last year. That's nationwide, and they feel like they're continuing to remain soft, and they should, because there's a lot of supply coming into the market, particularly at the high end of the multifamily market. We've got a record number of multifamily units in the pipeline going to completion. They got all bottled up during the pandemic, and now with the pandemic effects winding down, that's starting to come through. So all of what I just said would suggest that we are going to see the growth in the cost of housing services continue to throttle back. I will say, having said that this is taking longer than I had anticipated. I wouldn't have expected a stronger increase this month. I would have expected a softer increase. But again, I feel this is more of an accounting exercise than a forecast. It's not like I'm basing it on a model. It's just like this is the arithmetic involved in doing the calculation. So unless something has changed, seasonal adjustment plays an issue here too. So any given month, things can get particularly this time of year, can get really messed up by seasonal adjustment. So hard to read too much into it. But everything would suggest that this is going to continue to throttle the growth in the cost of housing service is going to continue to throttle back, and because it's such a large component of the CPI, that's going to drag overall CPI, consumer price inflation, back down to target. Is that helpful?
Absolutely.
Yep.
And so, I did want to also turn the conversation to the labor market, because there was considerable debate over the last big macroeconomic statistic that we got from the Bureau of Labor Statistics, the payrolls numbers. They sort of told a different story from the so-called household survey, right? The Bureau of Labor Statistics talks to both employers and they talk to households to try and understand how many Americans are employed. And the two surveys sort of told different stories. I think the way some economists have framed it is, although the headline payrolls number looks good, there are cracks under the surface, as it were. Obviously, room for a lot of different stories there, but
you're looking just for the dark side. I don't know what cracks in the. Oh, come on, that was the numbers are good. Come on. Lots of jobs, low unemployment, lots of labor force growth. Yeah, month to month things bounce around a lot, but come on. It's about as good as it gets. Literally as good as it gets. The unemployment rate's been below 4% for 2 years. 2 years. You have to go back to the late 60s to find something like that. It's like a really good job market. So, I think you got to be, especially the household survey, that's 60,000 households, right? Out of what, 135 million? Come on. And it's going to bounce a lot, and seasonal adjustment is going to be a big issue there. So at least take a 3-month moving average and you'll feel a lot better, Jonathan. Yeah.
All right. Well, I'm glad I have you here to.
You guys at Bloomberg, you're way too pessimistic. You've been way too pessimistic for a long time. Come on. This economy is about as, really, the numbers are good.
Well, you could also take the pessimistic view that, unemployment is maybe like below equilibrium as well. And this could keep, a more pessimistic read of this inflation
wage growth is moderating, Allison. There's no evidence that it's, why do you think that? If we were beyond full employment, we'd see wage growth accelerating, not decelerating.
Mm-hmm. Well, because it's still coming out of the pandemic, and you still have sort of tightening. You have vacancies coming down, but you could argue that this inflation report shows that inflation is being persistent. and is going to stick around further. And there was also an interesting note this morning from Torsten Slok arguing that financial conditions are already starting to loosen, just of anticipation and of the Fed rate cuts, and that will put upward inflationary pressure on, particularly housing. I don't know if that will bear out or not. So, I mean, you could look at this as, the last mile is going to be the hardest after all, especially services can be harder to come down. And, while wage growth isn't accelerating, that, the unemployment rate is maybe low, and this will continue to keep inflation from sort of coming down those last 100 basis points.
Well,
I don't know. I mean, if you look at core consumer expenditure inflator in the last 6 months, it's been, I think, less than 2%. That's the target. I mean, I think that overstates the case, obviously. I don't think we're there yet, but it feels like we're definitely moving in that direction. So, yeah, I mean, it could be more persistent. But here's the other thing. Why sacrifice the economy to the altar of a 2% inflation target anyway? I mean, really?
Well, that's a valid question. I mean, I guess
so, but my point is that you could be much more relaxed about the last mile, right? Because you don't need to get there like tomorrow, because nobody believes that it's 2%. It should be 2% anyway.
Yeah, I mean, I was listening. I didn't bother to go this year to the AEA panels on inflation, and economists are really stuck on credibility as being the most important thing. Although I was interesting to hear a couple panels. Every economist seemed to have a different story for inflation, so clearly there's no consensus. And I was
there should be. It's pretty obvious. I mean, the pandemic and the Russian war juiced up inflation. Now, as the pandemic and Russian war fade away, inflation comes in, and without any increase in unemployment or decline in economic activity. I mean, it's, yes, the economy is operating flat out, full employment, and it's not inappropriate for the Fed to weigh against that, and most importantly, to do that to keep inflation expectations down. But the evidence is, at this point, overwhelming that this was largely a supply side phenomenon. As the supply side normalizes, so does inflation.
Well, I think they're with you on about maybe all but 200 basis points of what inflation got to, and the Fed's role. That was interesting was people backing off from the view that expectations were everything, which I think a lot of economists believed up until maybe last year. So, I mean, maybe that does open the door to being less tied to meeting your target, or less tied to even having a target. There's just some cracks in this sort of that rock hard belief, in which case getting down to 2% does become less important. Because I think right now the Fed we got to make it to 2 because credibility is everything. But if there are other things that matter too, which I think Ivan Werning had an address to the AFA lunch where he talked about when maybe expectations, while important, aren't everything, then you do have more room to come down slowly.
Well, I'll tell you what, I'm going to disagree about almost everything you just said. I think inflation expectations matter a lot. I think that's what the one thing the Fed did exactly right. They made sure that inflation expectations remain nailed to the floor. And I'm not arguing that they should even suggest that 2% isn't their inflation target. That's their target, and they got to hit it, and that they got to maintain their credibility, and they got to keep inflation expectations down. I'm just saying that, once you're into the twos, and it feels like we're into the twos more or less on a sequential basis, not on a year-over-year basis. We're on a sequential basis in the twos. Then you can become much more relaxed about, that so-called last mile, getting it down to 2. And I think that's kind of where we are today. But anyway, I thought I'd liven it up a little bit, Jonathan. It was getting to be, I thought a little too kumbaya.
A little too kumbaya. Okay, very, very well. Well, I'll tell you who's also kumbaya here is the Treasury market this morning, because they after that sort of spike that I pointed out,
they back in,
kind of going nowhere fast. I mean, we're wiggling around here a little bit. We're sitting at 4.37% on the 2-year.
What about the equity market? Did you look at that?
I will
Let's see.
pull up the futures momentarily. Yeah, not a very strong reaction here.
Okay.
And I have to say that feels consistent with what we were I think talking about earlier, which is, gee, is if uh, if we feel like we know what the story is, it's really hard to read too much into this one particular number. The numbers are going to wiggle around month after month. And I also wanted to bring up something that happened last year around this time. Uh, we all in the financial media made a pretty big deal about how the CPI came in last December. We thought it was a pretty good story last December, actually. And then the following month, in February, when the January CPI came out and the Bureau of Labor Statistics updated its seasonal factors, it completely changed our interpretation of the numbers. Uh, and I'm not a month-to-month data miner like you are. I'm not digging into this stuff as a forecaster like you are, Mark. But I learned an awful lot from that experience, and uh, what it told me was, man, you really cannot hitch your narrative to any particular month's data, especially in December, knowing that
Well,
the whole story
also,
might change on you a month
yeah,
from now.
also in the post-pandemic period, right? Because the pandemic messed with the seasonals, in a very significant way because they just scrambled everything early in 2020.
Mhm.
So you've got to be very, very careful with the month to months, with data series that are very sensitive to seasonal factors, like the initial claims for unemployment insurance would be a great example of that. But CPI would be another example. The employment report would be another example. You have to be very careful with that. That's why, going back to your point about the household survey, got to be very, very careful with that, and just take a 3-month moving average just to help a little bit with that. That gives you a much better perspective on things.
Sure. I want to wrap it up here, but I want to give you each a chance to sort of put a finer point on all of this. Having seen the numbers, or at least having had a chance to glance at the numbers, how, if at all, will you be updating your inflation story today? Allison, what do you
Allison,
think?
you can go ahead.
Sure. I mean, I think as you said, like, I mean, 1 month, especially December, isn't enough to really update the story. Especially this number could be taken, as I said, one of two ways: is that we're continuing on our nice slow descent back to 2%, or it could show that we're stuck at where we at 3.5. So I don't think we can really read too much, but I'm cautiously optimistic.
I'm optimistic, Jonathan. We're good. We're good.
We're
The
good.
trend lines
We're
look
good.
good. We're good. I think you need to. If we haven't soft landed, we're pretty darn close, and the numbers are consistent with that.
All right. We'll leave it right there. Thank
Great.
you, Mark Zandi and Allison Schrager, for being with us today, and thank you to all our viewers.
Thank you.